If you try to learn how to manage your money online right now, you will drown in a flood of conflicting advice. One expert tells you to aggressively buy broad market index funds. Another tells you to completely ignore the market and start a side hustle. Both of these strategies can work, but applying them at the wrong stage of your life results in total paralysis. While information is abundant, the specific order in which you apply it determines whether you build momentum or spin your wheels. We have to divide wealth building into two distinct stages. Phase 1 is active generation. This is where you aggressively trade your time and effort to build a high-income skill. Phase 2 is passive preservation. This is where you utilize tax shelters and the broad stock market to protect and grow the capital you already have. When you have no capital, relying on passive investing strategies meant for wealth preservation can stall your progress for decades. To see why, we have to look at the actual numbers behind these returns. Let's look at a baseline scenario. A beginner starts with zero capital, but manages to squeeze out a $50 monthly surplus from their budget. This chart shows the outcome of investing that $50 a month into standard stock market returns. Over 10 years, the growth curve is slow and nearly flat. Now look at this second curve. This shows that exact same $50 a month redirected into learning a high-income skill. Within a few years, that skill results in a large salary bump, which is then invested. This salary bump increases the principal investment amount so significantly that the tiny gains from early penny compounding become mathematically irrelevant. When your starting balance is zero, the highest return on your effort comes from aggressively increasing your income, not chasing stock market yields. If you are currently operating with negative or zero net worth, you are a ground zero builder. You are in survival mode. To exit survival mode, you need to execute a 10-day financial sprint. This requires the immediate cessation of all non-essential spending. Every subscription, habit, and convenience that isn't strictly necessary is cut for 10 days. The math behind this sprint is simple. It is the fastest way to generate a $2,000 baseline emergency fund. This requires a difficult psychological trade-off. You will deal with extreme short-term lifestyle restriction and the mental fatigue of saying no to everything. However, that short-term sacrifice builds a critical cash barrier between you and the cycle of monthly financial anxiety. This $2,000 buffer is strictly for emergencies. Because you cannot afford a loss, this money must not be exposed to stock market volatility. Establishing this baseline eliminates daily financial panic. This frees up the cognitive load you need to focus on learning high ROI skills. This quadrant chart maps the capital required to start a strategy against the time and effort needed to execute it. If you are building from zero, you must stay in the top left quadrant, low capital, high time. This is where low-capital service businesses and AI prompt engineering are positioned. The input required here is high. You will need to dedicate 10 to 15 unpaid hours a week to survive a steep learning curve and constant outreach before you finally command a rate of $75 to $200 an hour. Before you launch any service, you must apply the MOM test. This is a framework for gathering unbiased, honest feedback from potential customers. Getting direct feedback prevents the catastrophic trade-off of wasting months building a service or product that no one wants to buy. Success in this early phase requires significant risk tolerance and intense active effort. Phase 1 wealth generation relies on trading your comfort and time to widen the gap between your income and expenses. Once you have a consistent surplus income from a corporate job or a business, you have reached the stagnant earner level. You are ready for Phase 2. Returning to the chart, our focus shifts to the quadrant where high capital meets low time. This is where low-cost, broad market index funds live. The primary benefit here is mathematical certainty. By copying a market index, you capture steady averages while completely eliminating the risk of a single manager making a bad bet with your savings. The psychological trade-off is that you must surrender any attempt to beat the market. You are trading the thrill of active management for long-term consistency. To protect this growth, you must route your investments through tax-advantaged accounts like a 401k, Roth IRA, or HSA. These accounts shield your compounding returns from the IRS for decades. Phase 2 success requires trading the excitement of the hustle for the boring, patient reality of compound interest. This decision tree maps your 2026 financial priorities. It narrows your focus to the specific actions that match your current net worth. If your net worth is currently zero or negative, your path branches to the 10-day sprint, followed by high-income scale acquisition. Invest 100 unpaid hours into learning data analytics or AI systems, ignoring day-to-day stock market movements. With a consistent surplus, your path is to capture your 401k match, fund your Roth and HSA, then deploy remaining cash into index funds. Attempting to skip to the end of this sequence before your income can support it ensures you will run out of capital before any meaningful compounding can occur. True wealth is invisible. It is simply the unspent gap between your ego and your income. Acquiring your initial capital requires aggression, hustle, and the ego to take significant risks. But keeping that capital requires the exact opposite traits: humility, fear, and passivity. This intense active energy is common among venture founders. While it takes massive risk tolerance and ego to build wealth at this scale, that level of aggression is nearly impossible to maintain over a lifetime without a crash. To succeed, you must correctly identify which phase of the journey you are in today, pick the correct game, and apply the correct mindset.